Hello and welcome back to the Brian Bailey Home Show. Today we're sitting here with Amanda Brune from Direct Mortgage Loans, and we covered some information about her first. We told you a little bit about, well, she told us a little bit about why she got in the mortgage business, of all the training, and I didn't understand they had to go through so much training and licensing, and you know, it's a really big deal to be a mortgage lender. But to be a mortgage lender that's trained and into the community is a great thing. So now we want to get into a little bit about the mortgage types. We talked about VA, FHA, and conventional. So I'm going to turn it back over to Amanda so she can break it down for you and tell you what's what so you can get started on the process. Amanda?
Thanks, Brian. So as you mentioned, there are several different types of loans. Most of them are government-backed loans, which are good because it means that the government is basically insuring these loans.
Okay.
The first type is the VA. VA and FHA are both HUD, we're considered HUD loans.
Okay.
VA has an excellent program where you have 0% money down for actually first-time and subsequent borrowers, which is a unique product and one that's only for the veterans or active military.
Okay.
It's absolutely wonderful. The FHA is a good program as well. The interest rates are very low, and they allow a minimum down payment of 3.5%, which throughout history, most folks have heard, you know, 20 years ago, you had to put 20% down,
Right.
or you couldn't get a mortgage at all. And those were the typical conventional type of mortgages where you put 20% down and you had your house. Most clients today don't have 20% to put down, especially first-time home buyers, which makes sense because they're not selling an asset.
Right.
Even second-time borrowers don't have 20% down, and some people don't want to put 20% down because the interest rates are so low. They find it's not a really good investment in their money at the time. They want to keep it in other things. So having a low down payment is not a bad thing. It's a really good way to get into a house.
Okay.
FHA does have some special, unique properties with it, and first is it has to be your primary residence.
Okay.
And VA actually is the same way. So in order to get those loans and take advantage of those rates, it has to be the only home that you're living in and that it's your primary home. Now you can later convert it to an investment property, but at the time of purchase it needs to be there. Okay. Conventional has a much broader spectrum of loan products, ranging from 3% down, which is only for first-time home buyers.
Really?
It is a newer kind of program that they offer. It's not as beneficial as putting 5% down, so if you have 5% to put down, conventional, it's a really good product. Many people don't realize you can do that.
Right,
you can pay mortgage insurance with the conventional product, just like you would with FHA. You can put 10% down, 15% down, 20% down, 50% down, any percent down you want.
Okay.
And every percent you put down helps you in term of payment and mortgage insurance. So there's lots of different variations in there.
Right.
And conventional loans are extremely beneficial and one of also the top type of loan products that that people go after. There's also USDA, which is a rural housing development loan.
Okay.
And many think that's got to be out in the Midwest or somewhere where it's just rolling fields and lots of land.
Right.
But in Baltimore County, there's several areas, and you know, Howard County, there's areas, Carroll County.
Right.
So you know, make sure if you're looking at an area that you check to see if it is USDA. There is income limits and requirements for those loans, but they are very beneficial. Then we also do the renovation loans, which not all lenders do. They are extremely intensive, but they're amazing products, especially to buy a house that's possibly been foreclosed on or short sale and needs some extra work. And then finally, we offer the Maryland mortgage programs. These are programs you might hear about, the first-time home buyer grants, or for instance, in Baltimore City, there's many programs available for first-time home buyers to get money to help them get into a house in some areas that may need extra renovation, and it's a really good product for first-time home buyers, and we are a lender that's able to do those loans as well.
Okay. One of the things that you did mention that I believe our customers want to learn more about is the mortgage insurance.
Yes.
Mortgage insurance protection, I believe that comes with a conventional loan. Can you talk about that?
If you don't have 20% to put down and you can't do a VA loan or USDA loan, the FHA and the conventional loan require something called mortgage insurance. Even though it's insurance, it doesn't really protect you as the consumer. It protects the lender. And mainly it's to protect in case you default on the loan, which doesn't mean that that's what they're expecting. And you have to have good credit scores nowadays to get, you know, any loan really. And you have to be qualified to buy the house. But it's just an extra protection for the lender since you're not putting down 20%.
Okay.
The difference is though, FHA requires mortgage insurance for a time period. So for instance, it could be on the life of your loan or be there for 10 plus years.
Okay.
The mortgage insurance on conventional loans is strictly tied to how much equity you have in your home.
Okay.
So if your balance drops below that 80% threshold, then your mortgage insurance can be taken away because at that time you're not as high of a risk for a default on the loan.
Okay.
And that's why conventional loans are great because you can have that come off and later have a lower mortgage payment, which everybody wants that to happen.
Right, right.
Yeah.
So you did mention with conventional loans you can put down 3% or 5% now with these new programs.
Yes.
But I guess the opposite side of that is that you may have to pay mortgage insurance longer based on the amount of equity that you have in this house going into the purchase, right?
That is absolutely true. And every percent that you put down, actually in 5% increments, would lower the mortgage insurance.
Okay.
So for instance, if you put 5% down, you could be paying $250 a month in mortgage insurance. If you put 10% down, that number could drop to $180 a month. These are just estimates.
Right, right.
But, or, you know, and again, if you put 10% or 15% down, the mortgage insurance gets lowered there.
Okay.
Also, the higher your credit score,
Okay.
the lower the mortgage insurance.
Wow.
So it kind of makes sense. It's a risk-based fee, basically. So, you know, they say, hey, look, you can buy a house and you can put down as little as you want, but we're going to require you pay this. And that's why these are considered Fannie Mae, Freddie Mac,
Yes.
which many people have heard of. Conventional is backed by those,
Okay.
and FHA is backed by HUD.
Okay.
So that's where the mortgage insurance comes into play.
Okay. What about VA?
VA is also a HUD product, but VA does not have mortgage insurance.
Okay.
VA has a funding fee, which is a little different, and is something that also is not a monthly fee. It's a one-time fee that you pay up front, and it can be rolled into your loan.
Yes.
It's also based on your military status,
Okay.
if you've used it before. Disabled veterans actually have that fee waived for
Wow.
them, which is amazing. Yeah, and the USDA, excuse me, has also something similar to the funding fee.
Okay.
They have something called a guarantee fee, and they also have a monthly fee, which isn't necessarily mortgage insurance,
Right.
but kind of has the same purpose, except it's a much lower percent and a flat fee. So it's sometimes a really good way to get into a home, depending on your situation.
Okay, well, it was great information, nice breakdown of VA and FHA Conventional, the USDA product, and some local products for Baltimore City,
Absolutely.
Baltimore County maybe.
Yep, anywhere in Maryland you can use
Yes.
the Maryland First Time Home Buyer Grants if you qualify.
Okay, okay. Before we go though, I want to make sure that we talk about the importance of having a good credit score. And what are some of the ranges for qualifying for a mortgage? I mean, can you get a mortgage if you have a 580 credit score, or if you have a 800 or 900? Does this give you almost like lower interest rates? I mean, what happens with that range?
That's a good question. There's a lot of buzz around the credit scores right now with all of the new companies online, Credit
Yes.
Karma, you
Yes.
know, credit this, credit that,
Yes.
freecreditreport.com.
Right.
And it's confusing. There's different models for credit score, and most people don't realize this, that if you were to buy a car and they were to pull your credit, it's a different type of credit report than we pull as a mortgage lender.
Okay.
So sometimes I find that the credit score that you think you have is not the credit score that you have, and that can cause anxiety, of course. The good news is there's many factors that go into the loan.
Mm-hmm.
Credit score is one of them.
Okay.
Obviously, you have to have minimum credit scores. We have a minimum credit score of 580 for FHA and
Okay.
VA loans. That is very low in the industry, and most companies don't go down that low. I
Okay.
will say that those lower scores tend to have other things called compensating factors. Possibly they have a very low debt ratio, meaning they have a lot of income per month.
Okay.
They may have a lot of assets that we can
Yes.
use. They may be putting more money down.
Mhm.
Typically, we have to take all those factors in
Okay.
to account to
Right.
figure out if they are approved in that respect.
Okay.
As far as the conventional products, they are much more credit score driven.
Mhm.
So obviously, if you have above a 740, that's considered excellent.
Okay.
That'll get you the best pricing available usually, and also help with the mortgage insurance and things like that.
Yes.
So it's not necessary, but it is beneficial
Mhm.
to have those higher scores.
Okay.
And in cases of products that were considered jumbo, which would be very high loan amounts,
Okay.
you have to have at least a 700 or a 720 credit score.
Okay.
So if you are looking in that range, credit score can be something that can limit you,
Okay.
but not negatively if you have options as far as purchase price.
Okay, well, good. Now, we're going to take a break again, and when we come back, since we're talking about credit score and interest rates, I want to get more into the different types of loans. You know, you have your 30-year, you have your 15-year, you have your ARM, 5-1, your different products when it comes to the type of 30-year, 15-year, and rate, and interest-only loans as well. So I want to talk a little bit about that and educate our listeners or our watchers or our audience on that. So can we do that?
Sure.
Okay, well, we'll be back. This is the Brian Bailey Home Show. We're here with Amanda Moon and Amanda Brune, right?
Yep.
So we'll be right back.